Let's look at the different ways you can actually make money with stocks. One way is when the price goes up for more than what you paid for it. The second is by being paid out dividends, a distribution of the company's profits. So let's look at what happens when the price goes up. Let's say you bought 10 shares in Facebook. Each share is worth $240 each. That's a total investment of $2,400. The share price increases by 20% in 6 months. Therefore, each share is now worth $288. This gives you a total profit of $48 per share. Let's look at the profit per share and times it by the amount of shares you have. So that's 48 times 10 shares. That equals a total profit of $480 within 6 months. We looked at what happens if the price increases over time, but let's look at it like this. What happens if the price decreases over a period of time? So let's say the price for this stock decreased by 20% over 6 months. Therefore, the price value will be in total of $192 per share, a loss of $48 per share. In total, for 10 shares, this will be a total loss of $480. However, we may want to look at it slightly differently. As you own the shares, even if the price goes down, you will only lose your investment if you were to cash in. If you are confident that the prices can go back up over the period of time, you could hold on to your shares and wait for the market to increase the price of your stocks. In this example, the price did go up by 25%. Your shares were $192 when it reduced from 20%. Now, your shares will be $252. In total, for 10 shares, that would be $2,520. So, if the price does go down on your stock, you could evaluate the market, identify if there's a bounce and the price will go back over time, and make a decision whether to sell at a lower rate or hold on to your stock and wait for the markets to climb back up.